Can a U.S. president fire a Fed governor? What are the implications, and where's the urgency coming from? That last part sounds a bit rhetorical because the U.S. is being laden with debt and is having trouble repaying it, issuing new debt as well to refinance. So, bit of a rhetorical question, but we need to get to the bottom of it. What is happening at the Fed? We had the Jackson Hole meeting last Friday, and we're still trying to work through the rubble here. Like, has the dust settled? Has the market really digested what came out of Jackson Hole? And what are the reactions to it? I've invited a phenomenal guest to discuss this. It's Jim Bianco of Bianco Research. Really looking forward to catching up with him because I couldn't imagine a better guest to discuss the implications of a potential rate cut in about 3 weeks' time. What does it mean? Should we anticipate it? Should we be happy about it? Or should we worry? Like Katie Stockton said on the program as well before. So before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously, and we much appreciate it. And by the way, it's free, so why not do it? Jim, it's great to have you back on the program. Thanks so much for joining me.
Thanks for having me.
Yeah, really looking forward to this, Jim. As I said, I couldn't imagine a better guest to really discuss the fallout from Friday's press conference and announcement coming out of Jackson Hole there in Wyoming. It's a beautiful scenic setting, but the tone or that of the meeting was sombering a little bit because they've changed tone completely. So I'm curious, what are your takeaways, and what do you make of it?
So he did change tone, and interestingly, the speech was almost identical to last year's speech. Last year's speech was we have to worry less about inflation and more about the labor situation because the unemployment rate was rising, and they wound up cutting interest rates 50 basis points in September and followed through with 100 total by the end of the year. But then we found out right after they cut rates last year, it wasn't necessary. It only spurred the fear of more inflation, and long-term yields went up. So now this year we come to the speech, and now he's more worried about slow payroll growth, and he's talking about cutting rates, and we'll see if we get a different outcome. What's the definition of insanity? Doing the same thing over and over again, expecting a different result. We'll see if we get a different result this time, but my fear is we won't. My fear is that we're going to repeat last year's mistake, is that the labor market is not as dire as the Fed suggested it was, and cutting interest rates is only going to produce more stimulus, which is going to produce the potential for higher inflation.
Yeah, it's interesting aspects to it. Like, we'll debate inflation versus employment here in a second, but last year afterwards, he sort of, like, maybe it was in the November press conference that he mentioned, we should have maybe started cutting in July. We've waited too long even. Do you think he'll have the same regrets? Like, should he maybe have started in July just to front run his own decision here?
No, I don't think he should have, because I think what's happened in the labor market, and what I find is very curious, is he seems to acknowledge this, but then is not willing to go the next step. Let me explain. Labor, there's 164 million people that have jobs in the United States. There's 212 million people in the United States of working age population, 16 to 64. If you're going to get more people working and get higher jobs, you got to start with looking at the population growth of the country. Is it expanding or is it contracting? Well, what we've learned is that the population growth of the country is dramatically slowing and maybe even being approaching zero because we've closed the border to the country and we're not letting immigrants in. The biggest driver, because we have a low fertility rate, has been immigration. So in 21, 22, and 23, when the border was wide open and we had people pouring into the country, we had all these millions of immigrants looking for jobs, putting downward pressure on wages, pushing up the payroll report. And now that we've closed it, we've got a dramatic reversal of that. The Fed calls this labor supply. Powell explained all this. He understands it, but it seems like and he probably understands the next part. We would look at a job payroll report of 20,000 or 30,000 and say, oh my God, this is a disaster if the Fed's got to cut rates before we have a recession. But if we have no population growth or very little population growth, 20 or 30,000 jobs might be all we need in order to continue to meet the needs of the country. I think Powell understands that too. But the problem is, why doesn't he say that? And I think what they're afraid of is he said, we can't tell the difference between labor supply and labor demand. What he means is, this is a low number and it scares everybody. And we don't want to look dismissive of it, even though we understand that there might be a reason why it's happening. So we're going to act like it's a problem and we're going to cut rates. So that's really what the question is demand slowing down? Is it that companies don't want to hire employers? The unemployment rate's not going up. That would be a sign of demand, and Powell has pointed that out. Or is it that every month there's not that many more people in the country looking for a job because we've got no immigration growth and we don't have enough 15-year-olds or 17-year-olds that are going to age into the working population as much as we have in years past. So we don't need a whole lot more jobs. And that's really the question about what's the state of the labor market.
Yeah, I've just been looking at the labor statistics. The unemployment rate has been at 4.2% for almost 12 months now. Like it dipped down to 4.1, came back up to 4.2, but let's say it's flat. So I was a bit surprised to hear that change of tone, because I didn't really have it on my Rolodex that he sees an underlying trend change. Yeah, we hear about like tech companies laying off 1,000 people here and there because they overhired in certain parts of their business. But overall, like what has changed the last 12 months? Like you've been trying to point out a couple like trends, but I don't, like from a pragmatic point of view, I'm missing something here.
I think what's changed in the last 4 or 5 months has been the border. That's what's changed in the population growth of the country, because that was slammed down shut by about April. But once the Trump administration came in January, by about April, they got it all down. The arrests have been going up. ICE has been arresting people. They've got 50% more people in detention now, something like 60,000 versus where they were in January, around 40,000. And that's causing a lot of undocumented workers to go into hiding. There was a story in the Los Angeles Times about a month ago that bus routes are seeing a noticeable drop in the number of people that are using buses in LA County, because that's usually the primary source that undocumented workers use to go to work. So this is all within the last 3-4 months is when this has happened. And we got these giant revisions to the payroll report. You could argue that was part of some of what we're seeing with this, is that when they release the payroll report, they only have partial data. They assume some things about the missing data. Well, they assumed wrong because of the slowing population growth, and that's why they had to dramatically reverse it lower. Of course, Trump got mad. He fired the head of the BLS because of that. And I might just, bluntly say that's another perfect Trumpism. Is the BLS got problems? Yes. Should they maybe think about changing the head of the BLS? Sure. But is it because they're being political and trying to make them look bad? No. So now we're off onto this other tangent, whether or not they're political, forgetting the point was maybe they're just doing this wrong and they need to think about it, how to do the payroll report in a different way.
I'm just looking at the job openings as well here, and it's not really showing up what you're suggesting. Like if I were to assume like a lot of illegal workers have disappeared from the workforce, at some point employers might go legit and hire real like documented workers. Like wouldn't the number, or at least post about those job openings as well, because they need help, obviously. Wouldn't that number start to rise here? It's dropping. Like since April, the number has been dropping.
Give it some time. The numbers revive. The JOLTS report, which referred to jobs opening, labor turnover, is a survey, and it has one of the lowest response rates. It's like under 30% or around 30%. That is subject to big revisions, and those job postings will lag. So if this is indeed the case, you should start to see it maybe stabilize and maybe start up by next year. But I do think that, that the big thing is that the labor supply is falling. And that was a prominent feature in Powell's Jackson Hole speech, talking about labor supply and talking about it falling a lot. So he acknowledged that this is happening. It's just that now that he said it, he's afraid to say, so therefore, what are the implications of it? And he seems to be, again, saying the implications are, it's a low number. We're all freaking out because it's a low number. Maybe we should cut rates. Well, maybe it's a low number for a reason and you don't need to cut rates.
Interesting. Like we'll get maybe to the tariff impact in a second. We can take it two ways now, or two directions. But maybe we'll stay on the policy. Or you said Powell caved in a previous interview earlier last week, or late last week. Did you still stand by that? And do you think the market thinks the same way? And did they really cave? Did they react to policy or pressure, political pressure?
I think he caved. I think he caved to policy. In other words, what I mean by caved is, July 30th at his press conference, he said the labor market's fine. It's the gold standard. And then we fired the BLS chair 2 days later. And then he said, I'm more worried about inflation. And then what he said on August 21st, literally 3 weeks later, was forget all of that. It's all turned around now. I'm more worried about the labor market than I am about inflation. And that's what I mean by, I think he caved to the policy response to the big shocking downward revision in the payroll report. The Fed always says, we never let one data point dictate policy. And then they always let one data point dictate policy. They did with the July payroll report.
Now, it's interesting because maybe I'll ask you about that. And it's like, what could derail a potential cut? The market expects 83% cut, but we are still getting a non-farm payrolls report, unemployment rate September 5th. We're getting core inflation and inflation data on September 11th. Interesting date, by the way. But is there anything that could derail those the September cut?
Yeah, I think those two things. I would say, yes, the number is 85, 83% the Fed's going to cut. But I would say it's a soft 85 or 83, meaning that if you get a rebound in the payroll report, and again, we're talking about 1 month. Sure, it could rebound in 1 month for any reason whatsoever. I'm suggesting that it would stay low over a longer period of time than 1 month. Or you get a above consensus inflation report, you could see that 85 go somewhere to near 50-50. And then that would throw everybody into uncertainty about what the Fed's going to do. That's what I mean by it's a soft number. It's still kind of dependent on the data that's coming as opposed to a hard number. It doesn't matter what that data shows, that they're already locked in with what they want to do. So, yeah, I mean, I expect the Fed to cut rates. You should expect the Fed to cut rates. You need to see an upside surprise in payrolls or CPI in order to start asking the question, will they actually do it? And a consensus number, below consensus number, will definitely get them to cut rates.
Yeah, I jumped the gun a little bit with that question because I wanted to stay on policy because we're getting some interesting news out of Washington and President Trump firing one of the Fed governors here, Cook, for apparently falsifying documents for some loan and mortgage documents. Not sure if those accusations have any merit at all, but can a president do that? And what is your reaction to that, Jim?
To answer your questions, yes, a president can. The Federal Reserve Act says that a president can fire for cause, and for cause is problem with the phrase for cause has never been defined. It's never been litigated. We don't know what that means. We do think it does mean it does not mean he disagrees with me on policy, like he wants Feds to cut rates and Powell won't cut rates. But it can mean things like fraud, malfeasance, unethical behavior, and the like. And you are correct. Lisa Cook is a Fed governor who apparently filled out 2 mortgage applications for 2 different properties and said that they were both her primary residence at the same time. Why would you do that? Because primary residences get lower mortgage rates than would a secondary residence. Their second house, the one in Georgia, she's renting out right now. And so that is, but yet the mortgage assumes that it was a primary resident. Now, it hasn't been proven, it's only been alleged. But I would also say, too, the Fed is a banking regulator. And what is being alleged is you defrauded a lender. To have a banking regulator be alleged to defrauding a lender is a big deal. If you were in the Maritime Commission and you said that I incorrectly filled out my mortgage application about a primary residence, well, okay, that's a different story. It's not good, but it's not as bad as a banking regulator doing it. So I find it curious that she hasn't addressed the allegation. There are some reasons why you would fill out both as primary as a primary residence. There are exceptions to that rule. So, what did you do here? Did you do something wrong, or did you not do something wrong? She doesn't address that. Now, what they say is Trump can't fire her for cause because there's been no for cause, meaning that it hasn't been proven. Is that really where you want to go? Just to be dramatic about it, do you really want to get arrested and go to court and prove this, and then you can be fired for cause, or do you really just want to step aside knowing that you did something inappropriate?
Yeah, it's like definitely provided an angle of attack for for the current president here, which makes sense. Which
Which
brings me
is
sort of
why, if I could just really quickly say, this is why we have the Senate confirmed. These are the types of things you're supposed to come up with. Remember, she was confirmed 3 years ago with a 50-50 vote with Kamala Harris breaking the tie. So she was already a controversial pick to begin with. But the Senate is supposed to investigate these kind of things precisely so somebody can't accuse somebody of this once they get into the position.
It feels like we're gonna have a Netflix movie about that as well, because I sense some intern will running down the hall and saying, "I found it," and that's what we've been looking for. It feels like that, or at least part of it, right? Can't shake that feeling. But let's talk about the impact of that. Let's say removal, if that really goes through. I understand it's still going through the courts, and you've been posting something on X, interesting on X about that as well. Because if she stays in her role, but then later on in a couple months' time, the court confirms that it was okay for the president to remove her, that she actually. You can say it way better than I. Maybe you want to complete my sentence here.
Yeah. Two things is that if she stays, she said, I intend to go to work tomorrow morning. Well, the problem with that is that the president of the United States says fired her effective immediately. So he says you're no longer an employee of the Federal Reserve as of this morning. And if she is at the Federal Reserve making decisions and setting policy, then the Federal Reserve is allowing a non-employee to set policy. Might as well ask me to set ask me to vote on the Fed, even though I'm not a Fed governor. Or you or anybody else that's listening to this. That's what she effectively has the same status as we do. Now, if a court gives an injunction and says she can go back to work, then maybe she could, continue on as being a Fed governor. But then that will only last as long as to whether or not the, appellate judges say that she can or can't do it. So this is putting the Fed in a very, very difficult position. And you'll notice she is fighting this with her own personal attorney. This is not the Federal Reserve attorneys and not the Federal Reserve helping her with this case. She has to do this on her own. So this is really putting it into a fraught decision. What does it mean, though, for policy? For the near term, not much. This is one less voter for the September meeting. Let's say maybe for the October meeting, too. Whatever they're going to decide to do, probably cut rates, they're going to do it anyway, whether she's there to vote or not vote. So at least in the near term, the next few months, nothing really changes. If she gets replaced and Trump gets to replace him with another Trump voter and he gets 4 of the 7 governors on the board, over the long term, that can, because what we're learning is it's always been in case, but we just never had to consider it, is, say, the one example I've been using, all of the bank presidents, the head of the Chicago Bank, the New York Bank, in Richmond, and Cleveland, and Philadelphia, and et cetera, they all serve 5-year terms. Their 5-year terms are up at the end of February 2026. They all have to be reapproved. 2-step process. The boards of these individual banks have to reapprove the president, if that's what they want to do, or put in somebody else. And then the Federal Reserve Board of Governors has to approve them through a vote. For the 100-year history of the Fed, they've never said no to any of these board presidents. But if Trump has 4 voters, I'm saying this as a scenario, not that they would, they could start saying no. We don't want Austin Goolsbee to continue as the president of the Chicago Fed, for instance. 4 of them say no, he's out. Chicago's got to go find another president. And they could do this with other presidents as well, too. So that could be an angle of what he's trying to do here. But if it's, I need to get a rate cut in September, you didn't need to get rid of her this fast. That's not changing the dynamic for a September rate cut.
Yeah, which brings me to the question of urgency in general, and which is an interesting path to take. I was going to ask you about Stephen Mirren and his appointment, but we'll table that for a second. But why the urgency? Like it sounds a bit like a rhetorical question because we all know the debt burden that is weighing on the U.S. But is that really the main reason?
I think the emergency is somewhat political. It's a good way to deflect and point to the Federal Reserve and to have some urgency. So whatever happens, the stock market wobbles or, some other unpleasant economic data happens. I've already been screaming that Powell is Mr. Too Late and it's all his fault. It's not my fault. So part of that could be political. Part of the other urgency might be, let's remember that Donald Trump is a real estate developer. And, let me piss off some of the people listening. The worst people to ask whether or not where interest rates should be are people in real estate, because they all think interest rates should be zero all the time and zero immediately. And that's kind of the mentality that Trump has, being a real estate guy. The proper interest rate all the time is zero. And if we're not at zero, we need to immediately get to zero. And so that might be part of the urgency that he has as well, too.
Yeah, like that's the interesting part, because we've seen the mortgage rates not really react to a Fed cut like we've seen last year. So the question is now, why is everybody so happy and eager to see a Fed cut now, when mortgage rates might not react or even go higher? Because I'm looking at the 20 and the 30-year bond market now, and the yields on the 20 and 30-year, they're actually going higher as we speak. So it's an inverse reaction that maybe people were expecting. What do you make of that? Is the bond market, are the bond vigilantes kind of angry?
Well, I would actually broaden that out real quick. It's not only have 20 and 30-year yields not going down as we've talked about rate cuts. I mentioned earlier they went up when the Fed cut rates last year. And I'll also throw in that the ECB has been cutting for over a year, and 10-year German bonds and the like are higher now than when they started cutting rates. And the same thing in the UK. They've been cutting rates several times over the last year or so. And the 10-year UK gilt is higher in yield as well. What does it mean when short-term rates are going down and long-term rates are going up? Let me put it bluntly. The bond market is rejecting the policy. It thinks it's the wrong policy. It thinks the policy is going to stimulate and cause inflation. It's not going to help an economy that needs help. Or as you know, the line that's been going around Wall Street is the stock market's at an all-time high, housing's at an all-time high, M2's at an all-time high, crypto's at an all-time high. What exactly are we trying to fix here? What is the problem? And if there isn't a problem that we're trying to fix with lower interest rates, then stimulation is just going to produce inflation, and that's why you're seeing interest rates at the long end of the curve respond when the Fed cuts or the ECB cuts or the Bank of England cuts with higher long-term interest rates.
I had Tom McLennan on the show yesterday. I think we're publishing the interview pretty much as we speak right now. But he advocated that, as you said, the Fed is too late. It should be trailing more, or the Fed funds rate should be trailing the 2-year. And we all know the 2 years around 3.7 right now, Fed funds rate 4.2. Do you agree with that statement? Do you see that correlation as well? And why would it be that way?
Well, I think in theory, if the 2-year note was more of a freely traded instrument, it would be a good metric to say where does the market think the funds rate should be. The problem with the 2-year note, just like Fed fund futures, right? Fed fund futures, 85%, 83% chance that the Fed's going to cut. The 2-year note is trading under the funds rate. Is that the market saying we think that the Fed should be cutting, that's the appropriate rate? Or is it the market resigned to the fact that the Fed is going to cut? So we're just pricing in what we think is going to happen. And it's the long end of the yield curve that's telling you whether or not it agrees that it's the right policy. The short end of the yield curve is actually telling you what the policy is going to be, whether or not they agree with it or not. If you were to somehow de-anchor the 2-year note from the funds rate, and I don't know how you can do that, then yeah, if you let that thing be a freely traded instrument without the influence, then it might be a better metric to tell you where short-term interest rates should be.
Yeah, we have to talk about market implications. Like we just touched on the bond market here. What do you think stocks will do? What is priced in? I'm always trying to figure that one out, because on the day of the Fed cut, what is it, September 22nd or something? I have it in my calendar.
18th.
18, yeah. So, how will the market react? Is the S&P going to jump another 100 points higher? Is it going to remain neutral because it's priced in? Curious what you think is going to happen.
I think it all comes down to how long rates respond to it. Which way do long rates go? Do they go up or do they go down? And if they go up, I think that it will be a big headwind for the market. By the way, when I talk market for this perspective, let me be sure that there's 2 stock markets. There's 10 or 12-ish, Mag 7 AI-ish stocks. And then there's everything else. Everything else really needs interest rates to come down. Not because those companies need the stimulation, it's that those stocks don't need the competition from bonds. The bond market, if the bond yields go up and you can get a bond fund at 5%, if the Fed doesn't cut, you could continue to get a money market fund at 4%. A lot of people are looking at that and going, that's like most of, or a majority of what the stock market will offer me in this environment, because most people think, given valuations, 6 or 7% seems to be, over the next several years, a good metric for what you should expect the stock market to return. Well, if the bond market's going to give me a 5% yield over the next several years, or money market funds are 4%, there's a lot of money that's going to say, you know what, I'll take the bond yields, I'll take the money market yields. It's not as much as the stock market's expected returns, but it's a lot less volatility. And in the case of money markets, it's no volatility. It's $1 NAV every day. And so as yields go up, the other stocks get that competition of having to say, well, here's the Russell 2000. It just made a new all-time high for the first time in a year, and it's barely beating bonds anyway, and yields are going up. That's too risky. I'll own bonds. Now, the AI stocks will be their own game altogether and a whole different ball of wax, because they'll just go up and down with whatever we think is happening with the development of AI. But I think the rest of the stock market could use the less competition. Not that the companies necessarily need lower borrowing costs for their earnings.
Let's use the last couple minutes here, Jim, to really discuss what should investors do. Like, we've touched on deflation before hitting the record button here. What do you expect to happen? Like, if Powell says, well, we're entering a rate cutting cycle, September is the first step. I personally expect deflation to appear, meaning investors to a degree as well, but home buyers, for example, to defer purchases because they know it's going to be cheaper next week. Right. Would you agree with that? And what should investors do in general?
Sort of, because remember that in the U.S. you can always refinance. So if you bought a house, you could also argue the opposite for the same reason. The opposite being, everybody run and buy a house now. Yeah, but mortgages are 7%. Don't worry, just get that house, get your butt in a house, and in 3 months you'll be able to refinance it, and then 3 months later you'll be able to refinance it again. And so you could see that kind of behavior as well too in the housing market in the U.S. But I think in general for investors, I'll go back to what I said before. I've termed this all year, the 4, 5, 6 markets: cash 4, bonds 5, stocks roughly 6, because of the high valuation. This is what should you reasonably expect the indexes to return over the next several years. Now, maybe the stock market cranks out another 20% year this year. Maybe it doesn't. But I do think that you don't want to be thinking that we're going to be getting, 15, 20%. Now, let me say something about 4, 5, 6. If we're in a 3% world, inflation world, 3% inflation world, which I think we are, a 6% return in stocks is actually pretty good. But we're so spoiled that we think that anything less than 20 is like a bear market. But that's not realistic to expect something like that. We've gotten that in the last couple of years. Great. Doesn't mean we're going to get that going forward. But if we're in a 4, 5, or 6 portfolio environment, then a portfolio that has some cash, has some bonds, has some stocks, maybe you want to own some growth stocks or risky stocks on the end of the spectrum. Yes, that's the way we should be balancing our portfolio. Gone is the days of, Tina, there is no alternative, and a diversified portfolio is owning semiconductors and software companies and large cap tech. That used to be what we called the diversified portfolio. But now it's more cash, stocks, bonds, and the like. And I think that that's the way we've got to start looking at it. And again, I can't tell you about, expectations have been so skewed that when I say the stock market's going to return 6%, people look like, they look like I, stole their Cracker Jacks or something. 6% is not a bad return. It's just we've been so spoiled with what we've seen the last couple of years. We think it's a bad return, but it actually isn't.
Yeah, how do you get behavior out of spoiled brats, right?
They get burned. They have to get burned, unfortunately, is what happens. They get their expectations to turn.
Exactly. And on that bombshell, Jim, we'll wrap it up here. Really appreciate having you on. It was what a wonderful conversation, extremely insightful. Where can we send our audience to follow more of your work, Jim?
2 things. Bianco Research is the name of my company. You can look at biancoresearch.com, our website, at Bianco Research on Twitter X, at Bianco Research on YouTube. Jim Bianco, my name, is what I go under on LinkedIn. We manage an index which has an ETF. The ETF is WTBN. Wisdom Tree is our partner, so it's Wisdom Tree, Bianco, Nancy. WTBN is fund's name. And you can go to biancoadvisors.com to find out more about the index and the fund itself. Thank you.
Fantastic, Jim. Really appreciate you joining us. We'll have to catch up again very soon, and maybe right after the next cutting cycle starts in September.
Yeah.
So we'll see what the implications are. But in the meantime, everybody else, thanks so much for tuning in. Hope you enjoyed this conversation with Jim Bianco. I tremendously did. If you did as well, please leave a like, leave a comment, and if you haven't done so, hit that subscribe button. It helps us out tremendously here fighting the algorithm on YouTube. Much appreciated, and we'll be back with lots more. Take care out there.